Markets are officially open for trade. Joining me now is Michael Lee, founder of Michael Lee Strategy. Michael, welcome to the New York Stock Exchange.
Thank you so much for having me.
So I understand you're feeling particularly bullish about the market right now. What do you think is driving this level of investor confidence?
So I think there's not a level of exuberance and prices continue to go higher, which are what I really like to see in that investors aren't ahead of themselves, right? And then coming out of the deep drawdowns we saw after the tariffs were announced, you get some very extended price action. The closest, parallel to that was out of COVID, right? And so the COVID lows, we saw a dramatic rally for 18 months before inflation and the Fed kind of caught up with everything. Well, in this situation, inflation's going the other way. And the Fed is becoming, will a year from now be far more accommodative than they are right now. So that, and I do not believe the market appreciates the earnings power that we're going to see over the next 12 to 24 months from the S&P 500.
Yeah, earnings came out way better than expected. What is your take on that? Do you think confidence was too low?
I do not think the street has its arms around what's going on with the economy. And we just got massive fiscal stimulus in the form of the big, beautiful bill. And then with the Fed stimulus, to be coming at some point over the next year, the combination of those with artificial intelligence is going to lead to some dramatic earnings power.
Okay, and do you expect a majority of companies to top estimates over the next year, and if so, why?
Well, as of now, we'll see how much those estimates come up, and then what guidance looks like. I think we're in a very good situation for the economy to heat up, and I think if you look deep in the inflation number we got yesterday, the key driver of it was margin expansion on plant and equipment, which is, I would say, is a direct correlation to the immediate depreciation element of the big, beautiful bill. So the higher investment we have in industrial production in the U.S., given its low base, would be a massive multiplier to that. And you combine it with what's going on with artificial intelligence, short-term interest rates coming down, while longer-term interest rates might not move that much. That steepening the yield curve will promote lending, greater bank earnings. So there's a lot of forces converging together. And then you have a labor market that's not extraordinarily robust, but it's not falling apart. So there's a room for improvement there as well.
Okay, we've seen a lot of movement with reciprocal tariffs. What is your take on that?
Yeah, that's, look, tariffs are a four-letter word to anyone that's taken an economic class in the United States, and it flies in the face of reality. If you look at what's happened in China and India over the last 20 and 30 years and the trade protectionist measures they have there, it's worked out extraordinarily well for their manufacturing and industrial basis. And to think that it would be different in a market like the US, where we have the lowest non-tariff trade barriers to any other country in the world, we have the best regulatory environment, we have the best capital markets, we have the best rule of law. These tariffs are a great source of revenue for the U.S. and a great incentive to produce things here. So I think they're going to have basically the opposite effect of what Wall Street believes, in that it's going to be a great source of revenue for the government as well as a kickstart to industrial production in the U.S. And if you look at what's going on in the EPA, taking away the endangerment finding, the deregulatory efforts that we're going to see with the use of AI from DOGE, and the immediate depreciation of plant and equipment that you're getting from the big, beautiful bill, you have a whole of government approach to manufacturing. And the multiplier for that for our economy is unlike any other investment, which is why all these other countries in the world have these protectionist measures, because these industrial production jobs and having it as a source in your own country creates such a multiplier effect to your economy. And given, again, how low of a base it is here, I think it's going to work out extraordinarily well.
Let's shift to AI. You say this, well, I mean, it is moving fast and really quickly. What do you're comparing it to the internet boom in the 90s. Can you talk more about that? Yeah,
so if you look at the infrastructure build out that we had in the 90s, and part of the reason we ended up in a dot-com bubble is the market believed that, the Ciscos of the world would keep needing to put fiber and wires into everything. And by about 1998, you had enough infrastructure to support it, so where you're in a mid to low single-digit growth year over year. So in the U.S. for artificial intelligence, that infrastructure, in 1995 dollar terms, we could be as much as 10 times that type of investment, and it's going to happen in a smaller period of time. And so I do not believe we are anywhere near there in terms of the infrastructure build out we're going to need for AI. So this is likely to continue far longer than the street believes. And the street, if you look at the numbers for a lot of these companies that are out there, whether it be a NVIDIA, a Marvel, or a Marvell, an AMD, that they believe in some point at 15 to 18 months, the growth rates for all these companies are going to fall off a cliff and that we're just going to get there, i.e. we're in 1998, 1999, and all of a sudden this is going to slow down. Like, we are much closer to the early 90s, and when you look at what's needed for the infrastructure build out, the demand for compute, we're not even at the era of the AI agent. So we're building large language models. Okay, the next will be, what do you do with those large language models? That's going to come in the form of agents and applications, which are going to use exponentially more compute than the large language models need. So the growth rate for a lot of this infrastructure needs to accelerate, not decelerate. I think the street has that wrong. It's the largest mispricing I've ever seen in my career. And so you have that on the back of all these other things that are going on, as well as the value add you're going to get from these agents and these applications. So it's, I could not be more bullish. I could not be more excited.
In about like 20 seconds, anything else we should have on our radar?
Yeah, CoreWeave, the street doesn't understand the stock. It's down like 50% since they announced earnings the other day. All the early pre-IPO investors, their lockup period ended yesterday, and so you have companies like Fidelity and Magnetar Capital that own a third of the company that haven't been able to sell any shares. So that's going to wash out over the next few weeks. I think the stock is a $500 stock by the end of next year from like $95 right now.
Michael Lee from Michael Lee Strategy, thank you so much for joining us at the New York Stock Exchange.